another session of financial behavior. We are into our fall series, so we are doing a little bit more education the next three presentations. So I'm looking forward to it. Today we will lead off with permanent insurance. Should it stay or should it go? Jeff Campbell, wealth advisor, is going to lead that discussion for us this evening. Eventually, we will get into these being in addition to live presentations, but live interactive. Just got to get through some compliance issues there that we have on our side to make sure we're compliant. Um, so we look forward to having those in the near future as well when we can have guests and people participating on a live basis. But at any rate, tonight we're just going to go through permanent insurance. Should it stay or should it go? And with that, I will get our presentation pulled up and off and running. All right. All right, let's get this slideshow going. All right, permanent life insurance. Should it stay or should it go? So
Yeah.
Marcus and Jeff are presenting tonight, and we'll make sure we get our contact information to you all after the presentation. Also, be sure if you have questions or additional comments or things you want to talk to us about one-on-one, feel free to visit our website at friarfinancial.com, schedule an appointment, and we'll be more than happy to discuss those things with you. All right, so Jeff will begin taking it away with the permanent insurance and going from there. So take it away, Jeff.
Yeah. So like I said, we're getting into permanent insurance today, whether you should go or stay. And this isn't a sales pitch by any means on these products. This is just purely educational purposes. Just kind of give y'all an overview of what these products look like. And so going into permanent insurance, we would start with the benefits of it and kind of how it can help you and what it is and how it can help you. So a lot of times, and I'm not fully seeing the shared screen yet, Marcus, but it's coming up, I
You're
think, on
not?
my end.
Okay, hold tight.
I see it, but I think it's a little bit behind on my side, but it's all good.
Okay, let me see why you're not seeing that well.
There we go.
Right.
Yeah, it's coming. It's there now.
All right, hold tight for me. Let me get back here. All right, let's try get this going again. Okay, is that any better, Jeff? Are you able to see that?
Yeah, I see it, but it's not in present mode. But it might just be on my end. Um,
Gotcha. Are you able to read the see the
yeah, I
bullet
got you.
to see them?
Yeah. So,
Okay.
yeah, just to get started, we'll start with the benefits of permanent insurance. So it starts. It's gonna grow tax deferred. So that growth inside that account is gonna grow without any annual taxes to it, like any other retirement account. You won't have to pay those annual taxes, and the tax on that growth will be deferred, and then a lot of times tax free. Those once you withdraw, that'll be tax free, up to your cost basis, which is very very important. So for these permanent insurance products, it's going to be first in, first out, which means simply you can take out what you put in first, and that withdrawal is going to be tax free. Annuities are a little bit different because they're LIFO, which is last in, first out, which means what you put in last is what's going to first to come out. And then on the funding side of things, there's going to be no income limitations and contributions up to the non-net limits. which is important because that means that's going to keep it as treated as an insurance and not a taxable investment, which is important. That's like I said, to keep those tax deferrals and tax-free withdrawals. Um, as far as loans go, you can take a tax-free loan against the gains, and it may offer wash loans after 5 to 10 years, which is also important. And that basically means just interest in equals interest out, and that's where you get the wash from. So from there, you also get creditor protection, which is that cash value is protected from creditors. It's viewed as retirements, which is what shields you from lawsuits in many states. So that's important. And then as far as the death benefit goes, the death benefit, I'm sorry, excuse me, is equal or is less the income tax free, is what it looks like. Um, it's always paid tax free for the to the heirs with an irrevocable life insurance trust, and it can also avoid estate tax, which is important. Markets will kind of trust on that eyelet a little bit as far as what that irrevocable life insurance trust is, to kind of give you more details, and then kind of give this like a total view of this in a real life example. If we have a high income client who's kind of maxed out the 401k and other retirement devices, they can use a permanent insurance policy as another tax advantage bucket that can give you some tax deferred growth as well as a tax free death benefit for their family, which is important when you're talking about leaving a legacy and leaving that inheritance to your family members that's left when we leave this earth. And so, as we're talking about the benefits, it's also important that we talk about the drawbacks of these products as far as it goes with any insurance product or any finance tool in general. There's going to be drawbacks to everything. So, if you want to go into the next slide, unless you want to touch on that eyelet, Marcus, it's up to you.
I can go back a slide. So,
Mm-hmm.
yeah, we can. Yeah, let's define that eyelet and delve down on that just a little bit more. So, where that comes into play is the fact that when you own a policy, it is part of your assets if you personally own it. So, in part of the estate tax, what we need to do is actually get that policy out of the person's name. So we have the irrevocable life insurance trust actually own that policy, such that those assets are not part of the accountable assets for estate tax purposes. And then that way, that allows the family to have um, a bucket to pay for the estate taxes, and they don't have to pay for those taxes out of the assets that are being left by the heir. So we'll touch on that a little bit more. Down the road when we get to those usages. But that in general is why that ALET comes into place, the irrevocable life insurance trust at a high level.
Mm-hmm.
So, yep, as Jeff said, we'll move on to some of the problems and drawbacks that we can run into with these types of policies, these permanent policies.
Yep. So as far as problems go, um, permanent insurance can be costly and really not flexible at all if it's designed wrong. So it's very important that these policies are designed correctly. So with surrender charges, which is the penalty if you cancel early, it kind of limits the access to the cash. That's one potential drawback that's very important. And there's also in these products, there's a lot of low early cash values because most of your premium cost is being paid off by those first couple of years of the policy. So you're not going to see much saving growth in that first couple of years because most of that money is going to the cost of the premium. And then, like I was saying before, the design of this is extremely important because with the wrong design, it can set up a large death benefit and limit that growth potential early on, which is important because all that money is going to the death benefit and not the growth potential. So, an example of this would be like a client. Oh, did you want to jump in right there, Marcus?
Yeah. Let's delve down a little bit deeper on the surrender charges for the
Yeah.
audience, and kind of like to always give or at least add the why to that conversation.
Mm-hmm.
So those surrender charges come about especially in products that are sold on a commission basis. So if you can imagine that you've got, let's say, $100,000 death benefit policy, or yeah, we'll just use $100,000 as a number and you've got premium as well as investment monies going into this policy. Well, the agent who sold that policy is being paid a commission on that product. So the agency, the insurance company needs to get that money back. That's why those surrender charges are there. And they require you to keep your cash value in that policy for X amount of time, normally about 10 years, because they need time to recapture the money that they paid that agent.
Mm-hmm.
So those surrender charges are going to be in that policy.
Yep.
And so what that means is if you've got $10,000 cash value, you might only get back seven uh, by year three, and then you get back eight in year four, something along those lines. So keep in mind, there are a lot of now fee only policies. In those cases, the agents, well, they're not agents, they're fee only advisors. They're not paid these upfront monies. And those policies work a little bit better for the client because now, from our standpoint, we need our clients to be able to access all of their funds as soon as possible, or at any time. And so, as fee only advisors, we're compensated differently. We're compensated for managing just the cash value of that policy to help you with the investment portion. It actually wouldn't make any sense to do it on an index policy because the policies fall under the index. There's nothing for us to manage. So there are ways for us to, if these policies make sense in your situation, there are some ways to design these policies to reduce those costs. So one, you do access your funds a lot quicker, and two, we're just reducing your costs so more of your money can work in the investment portion. So a lot of that design not only comes, and we'll see a little bit more in that design in just a second. I wanted to kind of just touch base on those surrender charges and what they actually are, why they arise, and that there are some things out there that we can do differently to assist in that manner.
Mm-hmm. And that's why design is so important because it's what limits the cost and fights back against some of those drawbacks that we're talking about. And also gets you your money as quickly as possible, which is always the end goal. So
Absolutely. So let's delve down, Jeff, if you can, into the next section with the screen we have up that has the design, kind of illustrates the design a little bit differently in terms of the cash value versus the death benefit and where those costs come in.
yeah, so and then my screen's kind of lagging behind Marcus, so I can't actually see the graph yet.
Okay.
Um, so if you can kind of get it started, then I can kind of jump in once you kind of get to talking about it because I can't see it on my end yet.
Sure. Okay. So what we've got here is as Jeff started talking, we've got when we first begin a policy, we have very low cash value in it. And
Mm-hmm.
in this situation, we've got $100,000 death benefit up here. So as you can see, this is a pretty wide gap. There's again very little cash in the early beginnings of the policy. And so there has to be some sort of coverage here to cover the cost of the insurance. So in these years, your cost of insurance is going to be a lot higher because the insurance company is on the hook for this difference. And as the policy grows, the cost of insurance tends to lessen because that gap is not as wide as we build cash value into this policy, and more of the money goes to the investment portion. So again, a lot of times these policies are positioned as investment vehicles,
Mm-hmm.
and if that's really the goal, we need a lower death benefit from the beginning because we're trying to lessen the cost of insurance and have more of the money go towards the investment portion. So that comes back to the design of the policy and is it really going to work for you for what the goal is? If the
Mm-hmm.
goal is actually protecting families and trying to generate a death benefit, and we'll get into this further. Again, this design may not be the optimal solution for that situation.
Yeah, exactly. And that's why design is so important, just because, like you said, limiting those costs is going to be the biggest thing and making sure it's applicable for your specific situation. As with any financial tool, making sure it's designed and tailored to what your situation is and it meets your goals in the long term. So that's why that graph is pretty important. So,
Yeah, absolutely. Now let's get into the a little bit deeper dive on these policies and how they actually work. So you have Before we look at this distribution curve, let's kind of define the three types of permanent insurance policies. So we have whole life insurance, in which the insurance company basically pays you back a dividend or interest, a stated interest amount, with some caps on it. So they may say, hey, for your, it's almost like a CD, kind of think of it like a CD in terms of how it works. So you've got a guaranteed interest rate. The next thing you're going to see is going to be the index universal life product. And that's probably what we get the most questions about is, hey, should I go into this index life product? With this index product, what happens is the investment portion is following an index, right? You get to pick the index, the S&P 500. Maybe it's the fixed income index, but you're following that index, and your rate of return is determined by the index. So today is September 9th. Let's say we had purchased a policy last September 9th. So there's going to be a point to point look back. So the market gained 11.2%. So that would be the crediting amount that the company is going to use. Let's say during that same period, the market lost money, had a -8 return. Well, they're going to kind of position this policy as, well, in the years where there's a negative return, you don't lose any money. So
Mhm.
they'll position it, as I have on the screen, zero is your hero. But the question is going to become, is zero really your hero? So as we look at this distribution curve, and again, the left side, we're losing money, is a negative slope. Oops, I didn't mean to go there. Let me go back. And then the right side is the positive slope. And this the distribution curve is just showing the probability of monies falling within one standard deviation of the investment, two standard deviations of three. So these are our normal things we expect to see. As we get a little bit further out, there are outliers and outperformers and things of that nature. But again, back to the example, if the market actually got 11.2% in that index policy, because we have this trade-off in years that you lose, you actually don't lose any money. Because that trade-off exists, the insurance company is going to cap your participation. And it may be, let's say, 7 or 8%. So everything above 7 or 8%, they're keeping. The insurance company is going to keep because of that trade-off. Um, that's not the best investment setup, right? We are what we want to manage always is this left, what we call this left tail risk, which is losses. And that's what we do as advisors. We're in here to manage those losses. Because by the same token, if there's an 11% gain, we want you to realize the entire 11% gain. We don't ever want to cut off what we call the right tail because we're giving up gain that we could perhaps keep with proper management. So that's kind of the trade-off and that we need to pay attention to in these policies.
Mhm.
You want to add anything, Jeff?
No, I mean, I think you hit the nail on the head. I think it's just, like you said, managing that, cutting off as much of that left tail as possible, cutting off as much of that low level risk, as well as, but trying to keep that right side growing is probably the biggest part. I wanted you to touch on that. So, no,
Yeah.
I don't have anything else to add.
Awesome. Awesome. All right, so let's kind of delve down into the two kind of areas in which insurance is in theory really needed. It's special needs planning and estate tax planning. So Jeff, if you can, and I know you might not be able to see the screen, but kind of
Mm-hmm.
talk about in theoretically, what is insurance for?
Lifelong support. I mean, for either your health or dependent's health.
Right, and income replacement, right?
Exactly, especially for term. Mm-hmm.
Right. So basically, I think we get a little bit lost in what the purpose of insurance is. So the purpose of life insurance is solely, by definition, to replace income.
Mm-hmm.
So if I've got a high income earner and sometimes maybe the spouse doesn't work, there's a high probability that and we don't want to disrupt that family lifestyle, we need a good chunk of money of insurance on the high income worker. We really don't need any insurance in theory on the stay at home person because there's no income that anyone is dependent upon. So that's one thing we see is that we kind of get lost in what the initial purpose of income of a life insurance is, and it's really to replace income.
Mhm.
Then we can step into those survivorship needs and estate planning. But yeah, I wanted to kind of really be clear on what that purpose of life insurance is. And then that gives us the ability, as Jeff said earlier, to pivot between term insurance because we're really just trying to cover the term of that person's working life.
Yeah.
And then
And that's where.
once they're no longer working, we technically don't need any insurance.
Mhm.
Now, as we go over to the special needs side, here's that case study on the special needs side. Um, you've got normally have two parents, but one parent doesn't work and takes care of the special needs child or special needs adult, could be a special needs adult as well. Um, so the care for that person is free. But what's going to happen when both parents have passed away down the road? Where is that care going to come from? How is it going to be paid? That's where permanent insurance is needed
Mhm.
in order to provide a bucket of money to take care of that special needs child or
Yeah.
special needs adult. Your design here becomes a special needs trust because we cannot have the child or adult touch the money because it could impact their government benefits. So the special needs trust will receive the money from the death benefit of the permanent policy, and there will be somebody to manage those monies and supplement the needs of that person throughout the rest of their life.
Mhm.
The way we do it is a guaranteed universal life policy that has very little cash value because we're not trying to grow cash value in this policy. We need that big chunk of money, the death benefit, to support the child. So this helps us with the cost of that policy and down the road, and it provides that bucket of money for the child's care or the adult's child's care. Because keep in
Mhm.
mind, special needs children tend to live normal lives. They tend to have regular life expectancies. So
Mhm.
we need a good sized chunk of money in order to help take care of them. The
Yep.
second use is, again, we talked about estate planning and to cover the needs of a family. So if you can imagine, I think the estate tax exemption currently is like $13 million, I believe. So let's say I've got a family who's got $20 million worth of stuff. So that means $7 million of the estate is going to be taxed. And we don't want the family to have to pay that tax bill out of the assets. So that goes back to having that eyelet set up where the eyelet owns the policy, gets it out of the estate. The family gets the money from the eyelet to pay that estate tax bill. And now they still get to enjoy the usage of that $13 million. So
Mhm.
that's kind of the key scenario. And in theory, these are the two scenarios where you actually need permanent life insurance. Otherwise, let insurance be insurance and let investments be investments. And we don't try and tie those two things together with combination policies. All right. So now let's go through the situation where we've got a policy, but now technically we don't need it. We find out we don't need it. This can be the case. Good example is we've got the person who is single, they've had this permanent policy, and they've never gotten married and they don't have any children. So technically, they don't have anybody dependent upon their income. So then they come to realize, like, I really don't need this policy. So we're going to go through the 5 things they can do with the policy in that situation. So Jeff's going to take that part away.
Mhm. So initially, the first thing we can do is we can cash in that policy. Um, Marcus kind of started. He kind of mentioned it earlier. He explained what surrender value is. So essentially, when you cash in that product, you take the surrender value and you pay the taxes on the gains because you need that money immediately. So you still have that capital gains tax that you got to pay. Those gains you got to pay taxes on. So that's your first option. That's a pretty popular one. Um, from the second one, you can go into maximizing that death benefit, which is essentially restructuring that policy to focus purely on protection of that money for your legacy. For whatever you want to leave behind, like Marcus was just saying, if that permanent insurance product, you want to leave it behind for whoever may need it once you leave this earth. We're going to focus on maximizing that death benefit and restructuring the policy to solely focus on that. Um, do you want to dive into that at all? Much more, Marcus, before I go to the next one?
Yeah, real quick. So, kind of a good example. Let's kind of give a good example of that. So again,
Mm-hmm.
I've got that single person who realizes I don't really need this policy. And let's say they've built up uh, $75,000 of cash value in that policy, and they're paying $300 a month for the policy, hypothetically. So what we can do is like Jeff says, we can do a tax-free exchange and purchase another policy with the $75,000. So we take that $75,000, we buy whatever death benefit we can. Let's say it buys $150,000 of death benefit, but you're done. Now we're going to reposition that $300 a month that you were spending towards some other financial need. It could be reducing debt, paying off the mortgage faster, or just investing. But once we realize we don't need this policy, there are things you can do to restructure this policy and use that premium a little more wisely.
Mm-hmm.
All right,
Yeah.
next, accumulation potential.
Yeah, and that's basically the flip side of that, where instead of focusing on a death benefit, we're going to redesign it for growth and kind of reduce those insurance costs a little bit. Um, yeah, and I'm trying to take an example off my head. You might have a one off your head, Marcus, where that same
Yeah, so
that
that
same
just
person.
Yep, and that just pivots back to our earlier discussion when we were talking about the cost of insurance in those policies and when they start out wide, and we were mentioning that that death benefit needs to be closer to the cash value. That's
Mm-hmm.
basically what we're talking about is we got to get that death benefit and that cash value as close as we can.
Yeah.
The other thing we're going to do though is if we're really trying to maximize the accumulation potential, you all see down here we didn't talk about the third type of permanent insurance policy, but you see the VUL listed on the screen. So that is a variable universal life policy. If you can imagine, just like in your 401k, you have investments that you pick, or your IRA or your Roth IRA. Inside of your investment policy, if you do the variable option, you have access to those same investment products. So
Mm-hmm.
you're able to take that investment and the investment portion of that policy and invest as you want to. And that gets
Yep.
rid of those surrender charges and it's very low expense. So if we're going to use this policy to accumulate value, we want to do it through a variable universal life policy.
Mm-hmm.
And generally speaking, if you're only dealing with an insurance agent, they can't sell you this policy because they don't have a securities license. That's why they're going to pivot to the index policy because they don't need a securities license. But as you can see, that index policy doesn't always turn out the best way for us to create cash value.
Yeah. And then it's important to kind of mention on this part, you're going to keep those tax deferral benefits while we're doing that as well. Correct, Marcus?
Absolutely, because we're still doing an exchange of a policy, so
Yeah.
there's no taxable event. The IRS does allow us to go insurance to insurance.
Mm-hmm. So, for example, if you had a business owner, and you can correct me on this if this example doesn't come off the way I wanted to, but if you have a business owner that has minimized the death benefit, and kind of use that VUL policy that we talked about before to kind of, um, they can use that VUL policy to grow supplemental retirement savings on a retirement basis. Since they've already minimized that death benefit, if that makes sense.
Sure, absolutely. Yep. You
Mm-hmm.
will see a lot of business owners pivot to these because they're looking for tax deferred growth. So
Exactly.
that is the because they've maxed out a 401k, they've maxed out the profit sharing, they've maxed out
Yeah.
all the pieces they can. So if they still have funds left over, they will use these policies to and we'll do it with the variable universal life in order to maximize that growth potential and keep that tax deferral.
Mm-hmm.
Absolutely. Um, Back to our situation though, we're going to talk about the last two places this kind of plays out in terms of converting these policies. So back again to that person that we talked about who was single, they never got married, they don't have any children, they had this policy, and they're trying to figure out what to do with it. Well, one key thing we just mentioned is they were single, no children. So they really don't have anybody once they get to later stages in life who's going to help take care of them should a long-term care event take place. So what we're able to do is Jeff's going to talk about is some long-term care planning with these policies.
Hmm. Yeah, so a lot of times we can use a tax-free exchange, a 1035 exchange, and move that old life insurance product into a hybrid policy that covers both life and long-term care. A spouse can be added to a covered person in that sense. A spouse can also benefit from that, and then um, whoever the heir might be, even though they might not have children, whoever that heir might be when it gets to that point, a long-term care benefit, if it's never used, can still pass on that value can still pass on to the heir, which is also an important piece. But like I said, it's all about finding a product that fits your situation. So for that single person, like I said, that doesn't have any heirs at the moment, it's going to be more beneficial to get out of that permanent life insurance and get something that covers both their life and their long term care planning in the near future. We can do that in a tax free exchange, which is important. So,
Yep, absolutely. So there are two ways we can go with this on that long-term care piece. So as Jeff's showing, and I'm kind of taking the screen back, we've got
mm-hmm.
long-term care insurance, and there's also long-term care annuity options. And again,
Yeah.
that's just an analysis of which one could be more beneficial. But always keep in mind when you're doing 1035 exchanges of that cash value, you can always go from life insurance to an annuity. But if you have an annuity in place, you cannot exchange back to a life insurance policy. So again, it's just a matter of again trying to take resources that you have. How can we best utilize those resources to get you to your goals? And that's just the it in a nutshell is
Mm-hmm.
how do we get you from point A to point B. But we thought it was really important to have this discussion tonight because it is one of the hot topics that we get a lot of questions about is index universal life, infinite banking. You'll hear that infinite banking and borrowing against my own money. The problem with that becomes you've got to have intent to pay the loan back. Otherwise, if you don't intend to pay the loan back, then you've actually used up that resource. So again,
Mm-hmm.
these smart strategies and how we kind of position assets, use assets, is the biggest part of this discussion. We started with insurance tonight. Jeff, we got two more things coming up in the near future. If you want to share those with everyone.
Yeah, I think next coming up we have IRA and Roth strategies, or Roth strategies inside your ROA and 401k plans and different things you can do with Roth dollars, which is going to be a fun one and something I think everybody, no matter age or generation, you can use. Then we go into estate planning, and we'll have a state attorney featured on here with us, if I'm correct, Marcus. Um,
We will, yep, we will have Mariah Street from Legacy Street Planning.
which will
And,
be fun too.
just in full disclosure, as we meet with clients and I say, how do you feel about your estate plan? I have had one person say they felt good about their estate plan. So it's a
Mm-hmm.
very important topic. October is estate planning month. So that's kind of why we're featuring Miss Street during that month. But anyway, really important topic. We hope to get some good information out to you then as well. So as always, thank you all for attending. Again, please visit us for our financial.com on the web, our LinkedIn page. Jeffrey Campbell has a LinkedIn page. I have a LinkedIn page. We also have the For Our Financial YouTube channel. So this video will sit live there. So you can always see it, plus all the other videos we've done. And again, we look forward to seeing you next time later in the month. I think it's September. I think we're going to do it on a Thursday, actually, the next
Mm-hmm.
one. September 25th, I believe. But anyway, we'll have it on our LinkedIn page and we look forward to seeing you. Thank you again for your time